Something catastrophic just happened to XRP that retail completely misunderstands. As of this morning, February 2nd, XRP crashed through 160 support and is trading around 156, down 6.4% in the last 24 hours, down over 20% in the past week. The technical damage looks irreversible. Traders are calling for 140. Bears are screaming that XRP is going back under $1. Social media is melting down. And if you're watching price action alone, you'd think XRP is imploding. But here's what nobody's telling you. While price collapses through critical support levels and retail panics, institutions just absorbed another wave of supply that most people don't even know exists. XRP ETFs crossed $1.3 billion in assets in just 75 days. That's the second fastest crypto ETF to hit $1 billion after Bitcoin. And here's the part that makes absolutely zero sense. In December, while XRP ETFs pulled in $483 million, Bitcoin ETFs lost over $1 billion, and Ethereum bled $564 million. Institutions were rotating out of the two largest crypto assets and into XRP. Yet XRP dropped 25% anyway. That disconnect is beyond abnormal. When institutional capital floods an asset at record pace, price is supposed to go up. When over $1.3 billion gets deployed in under 3 months, markets rally. When supply disappears from exchanges at historic rates, scarcity drives appreciation. But XRP is doing the opposite, and that tells you something profound is happening that charts can't show you. This isn't weakness. This is forced liquidation meeting institutional accumulation. This is retail capitulation being absorbed by smart money. This is exactly what market bottoms look like before violent reversals. Let me show you what's really happening as XRP tests 156, why this breakdown is creating one of the most asymmetric setups we've seen in years, who's actually buying at these levels, and why the next 30 to 60 days could produce a move that makes everyone who sold today look foolish. Because what you're watching isn't the end. It's compression before expansion. Before we dive into the data, let me be clear about something. If you're trying to understand how institutional capital actually operates during maximum fear events, how to read on-chain accumulation versus price capitulation, how ETF flows create hidden demand during crashes, and how to position when everyone is screaming sell but fundamentals are screaming buy, you need frameworks retail will never give you. That's why I built a comprehensive crypto course breaking down institutional psychology during crashes, supply dynamics during capitulation, whale behavior analysis, and portfolio construction for exactly these high volatility moments. This isn't theory. This is how you profit when markets make no sense. Links in the description. Let's start with what happened today and why it looks so devastating. XRP broke through 160 support this morning. That was the critical level everyone was watching. It held multiple times over the past month. Bulls defended it. Buyers stepped in. Technical analysts said if 160 breaks, next stop is 146. Well, it broke. Decisively. On heavy volume. And now we're testing 156 with momentum still pointing down. The chart looks brutal. Every technical indicator retail follows is flashing massive sell signals. The 50-day moving average is falling. The 200-day moving average is at 254, miles above current price. Super trend indicator flipped bearish. Bull-bear power turned negative. Awesome oscillator collapsed. RSI is oversold but showing no signs of reversal yet. XRP is trading in a descending channel on the daily chart. That's textbook bearish structure. Lower highs, lower lows, parallel resistance and support lines compressing price downward. Since mid-2025, this pattern has capped every rally attempt. And now we've broken the lower boundary. Historically, when assets break descending channel support, they accelerate lower. Stops get triggered. Panic selling intensifies. Weak hands capitulate. That's exactly what we're seeing right now. Volume spiked on the breakdown. Social sentiment turned apocalyptic. Retail is convinced XRP is going to $1 or lower. And technically, they might be right in the very short term. 146 is the next major support. If that breaks, 120 to 130 comes into play. But here's the problem with that analysis. It's entirely based on technical patterns and retail psychology. It ignores what's happening underneath the surface. It ignores who's buying. It ignores supply dynamics. It ignores institutional flow data. And those factors matter more than technical patterns during capitulation events. Because technical patterns are backward-looking. They tell you what happened. They don't tell you what institutions are doing right now in real time. And right now, institutions are doing something that contradicts everything the charts are saying. Let me show you the institutional data that nobody's watching. XRP ETFs launched November 13, 2025. In 75 days, they absorbed $1.3 billion. That's not retail money. Retail doesn't have access to deploy hundreds of millions through institutional channels in weeks. That's pension funds, asset managers, family offices, corporate treasuries, entities with mandate-driven allocation strategies operating on quarterly review cycles. And here's what's remarkable. XRP ETFs went 43 consecutive trading days without a single outflow. 43 days. No redemptions, no selling. Just steady accumulation day after day while price was collapsing from 240 to 170. Now compare that to Bitcoin and Ethereum. In December, while XRP ETFs pulled in $483 million, Bitcoin ETFs bled $1.09 billion in outflows. Ethereum lost $564 million. The entire crypto market was in risk-off mode. Institutions were pulling capital from the most liquid, most established crypto assets. But they were adding to XRP. Let that sink in. Institutions chose to reduce Bitcoin and Ethereum exposure while simultaneously increasing XRP exposure. That's not random. That's strategic positioning based on something retail can't see in the charts. As of mid-January, XRP ETFs held over 800 million tokens in custody. That's 1.2% of total circulating supply locked away in less than 3 months. Now layer in exchange balance data. XRP held on exchanges dropped 57% over 2025. It went from 4 billion tokens at the start of last year to 1.6 billion by January. That's 2.4 billion XRP, nearly 4% of circulating supply, removed from liquid markets in 12 months. Combined with ETF holdings, over 5% of all XRP is either locked in institutional custody or removed from exchanges. And that percentage grows every week regardless of what price does. So here's the obvious question. If supply is disappearing at historic rates and institutions are buying at record pace, why is price collapsing? The answer is simple, but most people don't understand it. Legacy holder distribution. Large holders who bought XRP years ago at 50 cents to $1 watched it rally to 366 in July 2025. They're now selling into any strength. When price rallies to $2, they sell. When it bounces to 180, they sell. When it tests 170, they sell. On-chain data shows large holders sold over $800 million worth in the past month. That's massive distribution pressure that overwhelms short-term demand. But here's the twist. Every single token those legacy holders sell gets absorbed by someone else. And the data shows exactly who's absorbing it. 42 new millionaire wallets were created in January alone. That's 42 addresses that accumulated over 1 million XRP each during price weakness. These aren't retail investors buying a few hundred tokens. These are multi-million-dollar positions being established while everyone else panics. Wallets holding between 1 million and 100 million XRP added 380 million tokens in Q4. Wallets holding over 1 billion XRP increased holdings from 23.35 billion to 23.49 billion since early January. That's 140 million tokens accumulated by mega whales during maximum fear. Think about what that means. At an average price around 170, 140 million XRP equals roughly $240 million deployed by the largest holders, while retail was panic selling. That's not speculation, that's conviction. That's smart money building positions during forced liquidation. And now, with price at 156 testing new lows, that accumulation is almost certainly accelerating. Because institutions love capitulation events. They love when retail gives up. They love when technical traders hit their stop losses. They love when social sentiment turns apocalyptic. That's when they get the best prices. Let me explain the psychology of what's happening because this is critical. In traditional markets, major bottoms form during maximum pessimism. Price breaks key support. Volume spikes on selling. Everyone who's going to sell has either already sold or is selling right now. And that's precisely when smart money steps in. Not because they're geniuses, not because they can predict the future, but because they understand that when forced sellers exhaust, there's nobody left to push price lower. Supply dries up, and when supply dries up, even modest demand moves price violently higher because there's no one left to sell. That's exactly the setup forming with XRP right now. You have massive distribution from legacy holders who've been selling for months. You have retail panic as price breaks critical support. You have technical traders hitting stops and closing positions. You have social media convinced XRP is going to $1. And you have institutions quietly absorbing every token that gets dumped. ETFs keep buying. Whales keep accumulating. Exchange balances keep dropping. At some point, and that point is getting very close, the sellers will be exhausted. And when they are, price will reverse violently because supply is already gone. Here's the data that confirms we're near that inflection point. Chaikin money flow, which measures institutional buying pressure, has been diverging bullishly even as price falls. Between January 5th and January 25th, CMF was rising while price dropped. That's a classic accumulation signal. Large capital is positioning for a move that hasn't happened yet. Additionally, trading volume has been declining during this consolidation and breakdown. Lower volume during weakness means fewer people are selling. When volume expands again, and it will, it'll signal new participants entering. If that expansion happens on upside, it confirms the reversal. If it happens on further downside toward 140, we get one more flush before the bottom. Now let's talk about fundamentals, because this is where the disconnect becomes absolutely insane. While prices collapse from 240 to 156, a 35% drop, the fundamental story for XRP has gotten exponentially stronger. Let me list what's happened in the past 3 months. XRP ETFs launched and absorbed $1.3 billion. Vanguard opened access to 50 million clients after refusing crypto for years. RLUSD stablecoins scaled to nearly 600 million market cap in under 2 months. Ripple received conditional OCC approval for a national trust bank charter. Ripple filed for Federal Reserve Master Account access. XRPL transaction volume hit 50 million in January, highest since 2022. Active wallets exceeded 5.2 million. Ripple announced partnerships with MasterCard and Gemini for stablecoin payments. DXC Technology integrated Ripple's blockchain into core banking platforms, serving $5 trillion in deposits. RippleNet processed over $1 trillion in payment volume last year. The SEC lawsuit is resolved. Regulatory clarity exists. Institutional infrastructure is being built at unprecedented scale. Every single fundamental metric is improving. Yet price is down 35% from recent highs and breaking critical support. That divergence cannot persist. Either the fundamentals are completely wrong and every institution allocating billions to XRP infrastructure is delusional, or price is wrong and will eventually catch up to reality. Which seems more likely? Here's another angle nobody's discussing: historical precedent. XRP has a well-documented pattern of lagging the broader market during rallies, then catching up explosively in compressed timeframes. In 2017, XRP sat at 20 cents while Bitcoin rallied from 3,000 to 15,000. Then, in December and early 2018, XRP exploded from 20 cents to 340, a 1,700% move in 6 weeks. In 2021, XRP lagged for months during the bull run. Then, when conditions aligned, it went from 40 cents to 190 in weeks. The pattern repeats. XRP consolidates or bleeds while attention is elsewhere, then moves violently when catalysts trigger. And right now, the catalysts are aligning better than they've ever aligned. You have regulatory clarity post-SEC resolution. You have institutional access through ETFs on every major platform. You have real utility scaling through RLUSD and RippleNet. You have banking infrastructure with OCC approval and Fed applications pending. You have supply being removed from markets at record rates. You have whales accumulating during panic. You have macro conditions making cross-border payment infrastructure more valuable as traditional banking gets expensive. Everything is lining up. Price just hasn't caught up yet. And the longer it takes to catch up, the more explosive the move will be when it happens. Let me give you the contrarian bull case on why today's breakdown is actually good for long-term holders. If XRP rallied to $5 on ETF launches without any pullback, that would signal retail FOMO driving price. Retail-driven moves collapse as fast as they rise. Institutional accumulation looks completely different. It's slow. It's painful. It happens during fear when retail capitulates. And it creates floors under price because institutions don't panic sell on 10 or 20% moves. They rebalance. They add. They operate on quarterly cycles, not daily emotions. So when XRP tests new lows while ETFs accumulate and whales buy, that's exactly what sustainable institutional adoption looks like. It's boring. It doesn't make headlines. It doesn't moon overnight. But it builds a foundation that supports much larger moves later because the holder base transitions from weak hands to strong hands. And once that transition completes, once everyone who wanted to sell has sold, there's no supply left. That's when price discovers a new equilibrium, and that equilibrium is likely far higher than 156. Because the supply that existed at $2 doesn't exist anymore. It's locked in ETFs. It's held by whales who won't sell. It's removed from exchanges. The float is dramatically smaller than it was 3 months ago. Now, let's talk about specific catalysts that could trigger the reversal. First, Fed Master Account approval for Ripple. If that announcement comes, it's a nuclear credibility bomb. RLUSD becomes backed by direct Fed reserves. No counterparty risk. Institutional trust explodes. Banks adopt RLUSD knowing it's federally backed. That drives XRP demand for liquidity bridging. Second, RLUSD crossing 1 billion market cap. It's at 600 million now. When it hits 1 billion, that proves dollar settlement demand is scaling exponentially. 2 billion becomes the next milestone, confirming RLUSD competes with USDC and USDT seriously. Third, BlackRock filing for an XRP ETF. They did Bitcoin and Ethereum, but haven't touched XRP yet. If BlackRock files, that's a credibility shock, pulling the most conservative capital into the space. Fourth, Clarity Act passage in the Senate. It passed committee on party lines. Full Senate needs 60 votes. If it passes, XRP gets explicit regulatory classification. All institutional uncertainty evaporates. Pension funds, endowments, insurance companies get green light. Fifth, major bank announcements using RippleNet at scale. Ripple has over 300 financial institution partnerships. When Tier 1 banks announce production deployments processing billions through XRP-powered rails, that validates the entire thesis. Sixth, exchange balances dropping below 1.4 billion. We're at 1.6 now. When it crosses 1.4, then 1.2, the supply squeeze becomes mathematically undeniable. Here's what to watch over the next 7 to 30 days to gauge whether this thesis plays out. Price action at 156 and 146. If we bounce here with volume expansion, that's the bottom. If we break lower toward 140 on heavy volume, we get one more flush before reversal. Either way, watch for volume spikes indicating new participants entering. ETF flow data. If weekly inflows stay positive or accelerate, institutions are adding during weakness. If we see sustained outflows above 50 million weekly for 3 consecutive weeks, conviction is breaking. Whale wallet count. If addresses holding over 1 million XRP keep growing, accumulation continues. If growth plateaus, distribution is winning. Exchange balance trends. If they keep dropping, supply removal accelerates the squeeze. If they stabilize or increase, tokens flow back for potential selling. XRP versus Bitcoin correlation. If XRP starts diverging positively while BTC stays weak, that signals XRP-specific demand. That's the earliest reversal indicator. Social sentiment. When capitulation is complete, sentiment hits maximum pessimism. We're close, but probably not there yet. When even bulls give up and posts calling for 50 cents start trending, that's the final flush before bottom. Let me address the bear case honestly, because ignoring it would be stupid. What if this really is the beginning of a collapse back to $1 or lower? What if institutions are wrong? What if ETF flows reverse? What if RLUSD adoption stalls? What if banks choose competing solutions? These are real risks. The probability has decreased significantly with recent infrastructure developments, but it's not zero. And that's why position sizing and risk management matter. You don't bet everything on any single thesis. You size positions based on conviction and risk-reward. You use stops. You have a plan for if you're wrong. But here's the key. At 156, with fundamentals this strong, with institutions accumulating, with supply disappearing, the risk-reward is dramatically asymmetric. If you're wrong and XRP goes to $1, you lose 35% from here. That's manageable with proper position sizing. But if you're right and XRP catches up to fundamentals over the next 6 to 12 months, you're looking at potential 300 to 500% upside based on analyst targets ranging from $4 to $8. 3-to-1 or 5-to-1 risk-reward on positions sized appropriately is exactly what you want. That's how asymmetric opportunities work. Here's the tactical framework. If you're long-term bullish on institutional crypto adoption and payment infrastructure, XRP at 156 is potentially the best entry you'll see this cycle. You're buying after a 35% pullback with fundamentals stronger than ever. You're buying while institutions accumulate. You're buying with supply at multi-year lows. You're buying 57% below all-time highs with infrastructure that didn't exist at 366. Dollar cost average over days or weeks. Don't try catching exact bottoms. Build positions as thesis develops. If you're a swing trader, 146 is your next level. If we bounce here at 156 with volume, that's a trade back to 180 or $2. Stop goes under 140. Risk reward is clear. Break below 140 and wait for next support before re-entering. If you're risk averse, wait for confirmation. Wait for price to reclaim and hold 170. Wait for ETF flows to stabilize above 80 million weekly. Wait for a major catalyst to materialize. You'll miss initial upside, but enter with higher conviction. Let me give you the bull case in its most aggressive form. XRP is the only crypto with live institutional payment infrastructure at scale. RippleNet connects over 300 banks across 45 countries and processed over $1 trillion last year. RLUSD is scaling toward $1 billion with BlackRock backing and Aladdin integration, managing $21 trillion. Ripple is applying for Fed master account access, making RLUSD backed by Fed reserves. The SEC overhang is gone. ETFs provide seamless access. Supply is being removed at record pace. If Fed approves the master account, XRP targets $5 to $6. If RLUSD scales to $2 billion while RippleNet doubles, XRP targets $4 to $5. If clarity passes, triggering institutional mandates with constrained supply, 8 to 10 becomes realistic. Here's another critical factor most analysts are missing: the timing of this breakdown relative to February's historical performance. February has been statistically XRP's worst month historically. Median February return is negative 8.12%. In 2025, XRP fell 29% during February alone. So seasonal weakness was expected. What's not normal is institutional accumulation accelerating during seasonal weakness. Typically, institutions wait for clarity before deploying capital. But right now, they're buying into the worst seasonal period. That suggests they have information or conviction that retail doesn't have access to. When institutions deploy hundreds of millions during seasonal weakness and technical breakdowns, they're positioning based on information asymmetry that creates opportunities for those who can read the signals correctly. Now let me address a question many are asking. Why would institutions accumulate XRP specifically instead of just Bitcoin or Ethereum? The answer comes down to use case and adoption trajectory. Bitcoin is digital gold, store of value. Ethereum is smart contract infrastructure, DeFi backbone. Both are established with massive market caps and slower growth trajectories. XRP is different. It's purpose-built for institutional payment infrastructure. It solves a $50 trillion cross-border payment market problem. And it's earlier in its adoption curve than Bitcoin or Ethereum relative to its use case potential. When institutions build crypto portfolios, they need exposure to different use cases. That's why capital rotated out of Bitcoin and Ethereum ETFs in December while rotating into XRP. Here's something else that's flying under the radar: the derivatives market setup. XRP options markets are expected to launch sometime in Q2 or Q3 based on how Bitcoin and Ethereum timelines played out. When options launch, they bring hedge funds, proprietary trading firms, and market makers who write options and hedge by buying spot. That mechanical hedging demand is independent of views on XRP's long-term value. As options volume grows, dealers buy or sell spot to hedge exposure, creating persistent demand that amplifies moves. Bitcoin options added massive fuel to its rally in late 2024. The same will happen with XRP. Plus, leveraged products from ProShares and Direction will generate additional liquidity and trading volume, creating better price discovery as the market becomes more efficient. Let me give you one more data point that's absolutely critical: the comparison to XRP's previous major bottom. In late 2023, XRP bottomed around 45 cents after years of sideways action and regulatory uncertainty. From that bottom, it rallied to 190 by July 2024, a 320% move. Then it corrected back to 60 cents, consolidated for months, and rallied to 366 in July 2025, a 510% move from the consolidation low. Now we're potentially forming another major bottom around 156 after a correction from 366. If this follows the same pattern, the The next major move could target anywhere from $4 to $8 depending on how aggressively adoption scales. That's 250 to 413% upside from current levels. The difference this time is the infrastructure supporting that move is exponentially stronger. Previous rallies were driven primarily by speculation and retail FOMO. This time, you have institutional ETFs providing steady buying regardless of sentiment. You have real utility scaling through RLUSD and RippleNet. You have regulatory clarity removing the biggest overhang. You have banking partnerships through OCC approval and Fed applications. You have supply being structurally removed rather than just holders waiting to sell higher. All of those factors suggest that if and when the next major leg up happens, it could be more sustained than previous cycles because it's built on fundamentals rather than pure speculation. Standard Chartered maintains an $8 year-end target based on $10 billion in ETF flows and continued supply dynamics. That's 413% upside from 156. Even conservative $3 to $4 targets represent 90 to 150% upside. And here's why today matters so much. Markets don't stay irrational forever. When fundamentals and price diverge this severely, one adjusts to match the other. Given that adoption is accelerating, infrastructure is being built, and supply is disappearing, fundamentals deteriorating seems unlikely, which means price adjustment is probable. And when price catches up after months of lagging, moves are violent because supply was already removed during the lag. Bitcoin did this exact thing in 2024. ETFs launched in January. Institutions accumulated through spring and summer, while price traded sideways 60 to 70,000. Everyone said ETFs didn't matter. Then October and November, Bitcoin exploded 60,000 to over 100,000. Why? Supply had been removed for 10 months. When demand returned, nobody was left to sell. Order books were thin. Buyers chased price higher. The same setup is happening with XRP right now, just 12 months behind Bitcoin's timeline. And the setup might actually be more extreme because XRP's float is smaller relative to the accumulation happening. If you want frameworks for reading institutional accumulation during crashes, understanding how panic selling creates asymmetric opportunities, interpreting whale behavior versus capitulation, and building positions during maximum fear when everyone is selling, check out the crypto course I've built. We break down real-world case studies like what's happening right now, teach you how to identify bottoms before they're obvious, and give you risk management for navigating volatility. This isn't about perfect entries or predicting exact prices. It's about understanding market structure and positioning intelligently when opportunities present themselves. Links in the description. All right, let's wrap this up. XRP just broke through 160 support and is testing 156, down 6.4% today, down 20% this week. The chart looks catastrophic. Technical indicators scream sell. Retail is panicking. Social media predicts $1 or lower. But while everyone watches price collapse, institutions deployed $1.3 billion into ETFs in 75 days. Exchange balances hit multi-year lows. Whales accumulated 140 million tokens during fear. XRPL transactions surged to highest levels since 2022. RLUSD scaled toward 1 billion. Ripple applied for Fed master account. Every fundamental improved. Yet price is down 35% from recent highs. That disconnect is not the end. That's the market transitioning from speculative holders to institutional allocators. That's legacy distribution meeting smart money accumulation. That's forced liquidation being absorbed by conviction buyers. And that process is nearing completion. When it finishes, when retail exhausts and institutions control the float, price catches up violently. The move will be explosive because supply is gone. There's nobody left to sell. Everyone watching charts thinks XRP is dying. Everyone reading data and flows sees institutions positioning for something big. One group is right. One is about to be very surprised. Based on the evidence, smart money is betting the surprise is upside. Today's breakdown might be the last chance to position before everyone realizes what just happened. Stay ready, stay liquid.